I'm Krishna and welcome to Who Said What. In this show, I dive into interesting comments made by notable figures from across the world, whether it's finance or the broader business world, and dig into the stories behind them. I can't believe I'm still doing this. I mean, we are on the 13th episode. But let me get started anyway. Today, I have four very interesting comments for you. So, Rajiv Thakkar of Parag Parikh Mutual Fund and Hiren Ved of Alchemy Capital and Ridham Desai of Morgan Stanley, all of them recently made some comments related to the recent market corrections. Let's start with the biggest factor that both Rajiv and Hiren highlight: the slowdown in economic activity and the direct impact on earnings. Rajiv points out how normal pullbacks are, emphasizing that if you are new to the equity markets, especially post-COVID, someone like me, this might feel shocking, but it's part of the course.
These kind of corrections are very, very regular, very, very normal in equity markets. A lot of investors have come to the markets post-COVID, both in terms of the demat accounts owned and in terms of the folios created with mutual funds, who would not have seen such a drop earlier. But let me communicate to them very clearly that this is part and parcel of the journey.
On a more granular note, Hiren lays out how earnings deceleration in Q2 and Q3 last year became the catalyst for a severe drop starting January.
The real deep correction only started from January. And a large part of this correction has its genesis in the fact that the economy slowed down considerably in Q2 and Q3, which in turn led to a significant slowdown in earnings growth.
From a narrative standpoint, Rajiv frames this as a standard market behavior. Any short-term shock triggers a new wave of sellers, while Hiren attaches it to a specific data on earnings. If you are feeling like your personal portfolio is in worse shape than headlines suggest, consider what they are saying. Hiren leans on median stock data, explaining that
the median correction in the top 500 companies was actually 33%. For the small cap, it was a staggering 37%. For mid caps, 33%. The next 50, which is just below the top Nifty 50 stocks, that was also down a staggering 37%. And even in the Nifty, it was 18%. So if you really look at it, barring the top 50 stocks in the Nifty 50, almost on a secular basis, the median correction in every market cap category, including the next 50 stocks, has been in excess of 35%.
Meanwhile, Rajiv underlines a related point. Just because the stock price fell 20% or 30% doesn't suddenly make it a bargain. He flips the spotlight from breadth of pain to the valuation question.
If the business is not very strong, if the earnings multiple were, let's say, 100 times before this fall started, and the stock has fallen 20%, then 100 PE stock has become 80 PE. Does that make it cheap? Answer is no. Can it fall further? Answer is yes.
Across the board, many stocks are down significantly, but as Rajiv warns, price damage alone doesn't turn a frothy valuation into a steal. So while Hiren calls out how everything's been hammered, Rajiv is cautious against chasing broken valuations that might still be precarious. Now both Hiren and Rajiv are quick to clarify the correction is real, but it's not on the same scale as the global financial crisis or the COVID crash. However, they do part ways just on how quickly we might see a rebound.
It is surely not a September 2008 or a October 2008 kind of situation or a March 2020 kind of situation that you should simply drain your bank accounts and fill your demat account. It's still not that kind of an environment. And I don't see again, someone was asking me, do you see a V-shaped recovery? So stocks have fallen and they should rise back equally quickly. My answer is no.
Hiren, on the other hand, highlights technical readings like only 10% of the stocks trading above their 200-day moving average and sees a strong chance of bounce.
Currently, we do believe that there is a very high probability that the markets are massively oversold and that we should see a rebound, which could be any time over the next few days or probably the next few weeks.
One sees an oversold condition ripe for a rally. The other warns that just because we are oversold doesn't guarantee a swift dramatic upswing. However, they do align on the idea that this is not a generational meltdown requiring extreme panic. On this very question of whether a bottom is here, Rhythm Desai offers a nuanced take that aligns somewhat with Rajiv's caution on calling a V-shaped rebound, yet recognizes the market potential.
It is very hard to time the bottom. I know Surbhi opened the show by saying, I think it's a bottom. I have no idea whether it's a bottom or not. What I know is that stocks are looking attractive, and in time this may prove to be a good time to engage. There's a lot of uncertainty around. It's a lot less than the uncertainty we experienced during COVID.
He suggests that timing a bottom is extremely difficult, but emphasizes that the attractive valuation setup might still make it worthwhile to get invested. Now the big question is, should you buy now or should you wait? He remains more confident that the market is at or near bottom.
I think we may have just seen almost the worst getting priced in. I am fairly confident whatever incremental cash that we have in the portfolios, we are very clearly on our path to deploying all of that over the next few days, as we believe that the risk reward in the markets is favorable at the current point in time.
While Rajiv said something along the lines of that if you're a 25-year-old, put 90% of the money in equities for the long term. The only thing is that don't stop the journey midway. Don't fixate too much on the upward and downward movements of the market. Here, Rhythm Desai also believes there's a clear opportunity on the horizon, particularly in the broader market just beyond large caps. He points out that foreign investors have gone unusually underweight on Indian stocks, setting the stage for potential outperformance.
Now, if you look at the foreign portfolio position in India, they are the most underweight they've been on Indian equities ever. I think India will beat these markets.
India will outperform from here.
And I think small and mid caps will do quite well into the next few months. Maybe they go down first a little bit more before they turn around, but it's very hard to catch them.
So India outperforms many emerging markets from here on, and the breadth of the market, the broader markets will outperform from here on.
I think India outperforms the world at large. I think, yes, mid and maybe from a sectoral perspective, you've not asked me, but financials are doing well right now. I think they'll lead this market out of its problems, and then it will transfer to consumer and industrials and other sectors.
This resonates with Hiren's hope for a rebound, but adds a key layer. See, Rhythm sees leadership coming from small and mid-cap names, and he underscores the challenge of nailing the precise bottom, a theme that both Rajiv Thakkar and Hiren Ved echo in their own ways. Ultimately, all of them converge on the core principle that corrections are inevitable. They diverge slightly on how aggressive to act right now, but they are all clear that this isn't a meltdown of 2008 or early 2020 proportion. Now on to the second comment. Torsten Slok, who's the chief economist at Apollo Global Management, he recently wrote a piece titled "What is Mar-a-Lago Accord?" And his piece seemed more like a thought experiment to me. See, in his article, he starts by explaining why the US dollar is the global reserve currency. He says, and I'm quoting him here, the US dollar is the global reserve currency because America is most dynamic economy in the world, and the US provides stability and security. He notes that since everyone wants to own this world's safest asset, it puts constant upward pressure on the dollar. Even though the US runs a trade deficit, that doesn't stop the dollar from staying strong because global investors view it as their best bet in uncertain times. But according to him, there is a downside to having a strong dollar all the time. American exports get more expensive and the country's manufacturing sector finds it tougher to compete with cheaper imports. So he floats this notion of Mar-a-Lago Accord, an international deal to deliberately push the dollar down. Now, what is this accord? He describes it like this. With safe asset flows putting constant upward pressure on the dollar, there is need for a deal, a Mar-a-Lago Accord, to put downward pressure on the US dollar to increase US exports and bring manufacturing jobs back to US. He essentially imagines the US telling its allies, "We'll provide you with security and access to our market if you agree to help depreciate the dollar." By weakening the dollar, US manufacturers would become more competitive globally. That could, in theory, bring more factory jobs back home and also help with the US debt situation. Now, if you're wondering if something like this has ever happened before, It did, back in 1985. The Plaza Accord was a real agreement between US, Japan, West Germany, France, and UK to weaken the dollar. It worked, at least in the short run. The US dropped significantly against other major currency, which helped US exporters. Now what he is suggesting in his piece sounds a bit like the Plaza Accord 2.0, but this time it's much bigger, more global approach, looping in not just the traditional G7 partners but also Middle Eastern and Latin American nations. Now why weaken the dollar? See, I've covered some of it, but a weaker dollar means it takes fewer euros, yen or other currencies to buy each dollar. That makes US made products cheaper for foreign buyers, which can boost US exports. He also believes it could solve a few problems at once. By making American goods cheaper overseas, companies might expand domestic production instead of relying on imports. He suggests swapping some US government debt into ultra-long century bonds so that interest payments are spread out over a long period. Other countries get security guarantees and US market access, while the US gets help in nudging down the dollar's value. Here's an exact quote from the article that sums this up. The Mar-a-Lago Accord is the idea that US will give the G7, the Middle East and Latin American security and access to US market. And in return, these countries agree to intervene to depreciate the US dollar, grow the size of the US manufacturing sector and solve the US fiscal debt problems by swapping existing US government debt with new US Treasury century bonds. He talks about two major tools that US might use. First, tariffs. He points out that tariffs not only protect local industry but also raise tax revenue. That money then could be used in any number of ways possible to offset some of the fiscal deficits. Second, sovereign wealth fund. The government could create or expand a US-based sovereign wealth fund that buys foreign currencies like the euro or yen and in doing so sells dollars into the market, which further weakens the dollar's value. It's worth noting that if any country openly intervenes to weaken its currency, it can be seen as currency manipulation in some eyes. Now that's part of the controversy or the question. How would other nations respond, especially if the US is also slapping on tariffs? Towards the end of his piece, he wrote three big questions. First, shifting supply chains and rebuilding US manufacturing could take years. Does the US have the patience to see it through? Second, a weaker dollar makes imports more expensive. That, coupled with higher wage US manufacturing, could push inflation up. Now, is that a fair trade-off? Third, tariffs might push other countries to diversify away from US markets or beef up their own defense spending. Would they really stick to a deal that weakens the dollar if it hurts their own exports or advantage? Crucially, this isn't something the US is actively pursuing. His main point is that a strong dollar is almost inevitable because of global demand for safe assets. But if the US wanted to reverse that and supercharge domestic manufacturing, it would need a broad international agreement. Now for the third story, I'll look at some comments that Neelkant Mishra made. Now we all know Neelkant Mishra is a chief economist at Axis Bank and a member of Economic Advisory Council to the PM. He recently gave a talk at United Way of Chennai's non-profit organization. Now Neelkant Mishra is one of the most thoughtful observers of the Indian economy, and I watched the video and wanted to share a bunch of things that I learned. While most of us now wake up to check what new tariff or policy Trump has announced overnight, Neelkant Mishra offers a crucial perspective. The drivers of India's economic growth over the next few years remain primarily domestic. This distinction between headline-grabbing global turbulence and fundamental growth drivers forms the backbone of his analysis. He identifies a clear global slowdown with worldwide growth expected at just 3.2%, significantly below pre-2008 levels when Chinese acceleration drove higher global growth rates. More concerning is what he calls significant forecast uncertainty driven by increasing industrial policy actions worldwide. The current trade tensions represent just the beginning of what Mishra describes as a very turbulent phase. Unlike many commentators who focus narrowly on tariffs, Mishra emphasizes that tariffs are only a very small part of industrial policy toolkit. Countries increasingly deploy export subsidies, tax credits, FDI incentives, labor subsidies and quality control orders to restrict trade. India itself has begun using quality control orders as a key tool to limit imports. Now, what makes the situation particularly untraceable is China's manufacturing dominance. He says,
China is over-indexed on every single industry which is growing rapidly today.
From solar panels to energy storage and electric vehicles, China controls 60 to 90% of global capacity and production. Their share of global manufacturing currently is around 35% and is likely to increase further as these growth sectors expand, creating structural tensions that tariffs alone cannot resolve. Neelkant Mishra makes a profound observation about the escalation path of trade conflicts. When tariffs prove ineffective, as they already are, with Chinese goods being rebadged through Vietnam, Malaysia and Mexico, countries turn to currency manipulation. He notes that during 1930s trade war period, currencies moved by 50 to 100% against each other as countries sought economic advantage. Now looking at the present conditions, he connects Trump's recent statements about crypto reserves directly to this dynamic. He says his problem is that the harder he works with higher tariffs, the more the dollar appreciates. Therefore, he has to somehow find a way to devalue the dollar. This explains Trump's increasingly desperate measures like discussing strategic crypto reserves, ideas that would have been unthinkable even yesterday. The Chinese yuan faces its own vulnerabilities. Despite China's persistent trade surpluses, it has experienced $1.4 trillion in capital flight over the last decade, with Chinese interest rates at 1.5% versus US rates at around 4.5% combined with collapsed inbound FDI and continuing outbound investments of $200 billion annually. Mishra notes the RMB is already quite vulnerable and therefore it is very easy for the Chinese government to allow it to depreciate to counter the threat of tariffs. As global trade fragments, he predicts a sharp rise in bilateral and regional trade agreements.
What you see on the left is the number of regional trade agreements. So bilateral agreements and small regional agreements will become much more common. This means suboptimal solution. As we all know, global optima are better than local optima, or a combination of local optima. But without the US, I don't think multilateralism is going to work.
This creates both challenges and opportunities for India. If the US pressures India to lower import tariffs, Mishra surprisingly welcomes this. He says,
if the US arm twists us into lower import duties, frankly, I would be very happy with that.
He argues that while reduced tariffs might cause short-term pain, they create significant productivity advantages if implemented judiciously. Particularly important since India has among the highest import tariffs in the world. As capital becomes scarcer globally due to US shift from tight fiscal loose monetary to tight monetary loose fiscal policy, competition for investment will intensify. This makes improving ease of doing business even more critical for India.
It's a beauty parade that just got tougher, and therefore we need to work even harder.
He identifies two major risks in current US policy that receives less attention. First, America has been running pro-cyclical fiscal policies, maintaining high deficits despite low unemployment. This approach leaves little room for fiscal support when economic challenges emerge, potentially triggering significant uncertainty and turmoil in financial markets. He compares this to an asteroid impact, unpredictable in timing but devastating in effect. Second, the claimed 87% reduction in immigration threatens US growth potential. He notes that recent US economic strength stemmed partly from fiscal stimulus but also from immigrant labor supply. He says now they are going after both of them.
Now they are going after both of them, and this is something that is likely to go through a lot of negative surprise.
The only counterbalancing positive is deregulation, which could boost productivity across financial services, energy, healthcare, and drug discovery. But these benefits will materialize only in the long term. He says,
we are not going to slow down strategically to or structurally to a 5.5–6% growth rate.
Instead, he identifies three specific cyclical factors behind recent weakness. First, fiscal tightening. The central government's fiscal deficit accumulation in the first 4 months of the fiscal year was well below trend, an unintended fiscal tightening that is now being relaxed. However, he disputes the narrative that FY26 will bring consumption stimulus, noting that the government is still shrinking its footprint in the economy, which is the right thing to do. Second, regulatory constraints. Multiple regulators are now pulling back.
On the regulatory side, we are seeing several regulators pull back from being excessively tight and trying to micromanage and getting into prescription type regulation rather than principles-based regulation.
Third, monetary conditions. This represents the most significant continuing challenge. A directive to bank to reduce loan deposit ratios created a downward spiral of credit growth. Meanwhile, RBI interventions to support the rupee have required selling dollars and buying rupees, shrinking durable liquidity to negative levels as a percentage of deposits. This makes interest rate cuts completely ineffective until liquidity is restored. Neelkanth Mishra argues that India's strength growth remains around 7%, composed of 1% from labor input, 1.5 to 2% from total factory productivity, and an accelerating contribution from capital formation as investment rebounds from its 2021 low of 27% of GDP down from 34% in 2012. Crucially, he identifies the primary driver of this investment decline. He says,
unlike all the narrative around private sector capex, was primarily because of real estate.
Neelkanth Mishra's analysis provides a framework for understanding how global fragmentation will reshape economic relationships while highlighting India's domestic growth drivers that remain largely independent of these external tensions. His identification of cyclical rather than structural factors behind India's recent slowdown, combined with clear explanations of specific policy mechanisms affecting liquidity and investment, offers a roadmap for navigating both global uncertainty and domestic opportunities in the coming years. Now for the last story, Louis Gaff, founding partner and CEO at Gavical Research, recently shared his insights on CNBC's show. Now, Gavical Research are known for their commentary on daily global macro events and emerging trends. His perspective is particularly valuable as markets navigate uncertain terrain. I watched this interview and wanted to share some key insights I found most valuable. See, the Trump's focus has shifted dramatically. According to Louis Gaff, instead of celebrating stock market records as he did in the first term, Trump now has 3 goals: lower bond yields, a weaker dollar, and cheaper oil. Now, why this change? He points out to a specific threat few are discussing. In late 2025, a massive wave of corporate debt needs refinancing.
In the second half of 2020, interest rates were at record lows. Every single US corporate went out and issued debt.
Most of this debt was issued with 5-year terms at interest rates below 2%. If companies must refinance at today's much higher rates, they'll need to cut spending and jobs to afford the increased interest rate payments. They would damage the economy just before the 2026 midterm elections, a political disaster for Republicans. Trump's strategy, therefore, he suggests,
take the pain up front, get the lower interest rates, so that the economy can be rebounding by 26.
This explains why Trump and his advisors now talk about bond yields rather than stock prices. See, tariffs aren't really about stopping illegal drugs or raising revenue, despite official statements. Louis Gaff sees this as bargaining chips.
The tariffs remain a tool, and it's a tool that you're going to use to beat up America's trade partners, whether Japan, whether Korea, whether China, and to say, look, guys, I'm going to tariff you unless you go out and you buy US treasuries and unless you raise the value of your currency.
This is sophisticated financial strategy disguised as trade policy. Trump wants foreign countries to buy more US government debt and strengthen their currencies against the dollar. Both actions directly support his 3 main economic goals. The May meeting between Trump and Xi Jinping could produce what he calls Mar-a-Lago Accord. Now, we just spoke about this above, so I'm not going to repeat what it means. Beyond technological party, China's recent advances in artificial intelligence have profound market implications. He highlights how China's DeepSeek AI breakthrough has shattered the illusion that the US could maintain technological dominance over China. This development undermines a key assumption driving US tech stock valuations.
The widespread belief was that all these huge Mag 7, these big cap tech stocks, could in essence build monopolies for themselves through unprecedented capital spending.
If Chinese companies can match American AI capabilities with less investment, it challenges whether US tech giants deserve their premium valuations of 35 times earnings, 40 times earnings. Inside China, powerful financial forces are driving a substantial stock market rally, with Chinese government bonds yielding basically the lowest in the world and the country generating a massive $1.1 trillion annual trade surplus. Domestic investors need places to put their money. Unlike previous Chinese market rallies that depended a lot on foreign investors, this one is fueled by domestic money.
The default mode is shifting from I buy gold and I buy bonds to I buy equities.
With traditional safe havens offering poor returns, Chinese investors are turning to their domestic stock market. He offers a specific indicator for spotting the eventual market top.
The sign of the top in China, for me, will be probably 6 to 12 months after you get the Alipay, the ByteDance IPOs, like all the big names and all these guys come in.
This wave of major IPOs would signal excessive optimism and potential market saturation. See, for the past decade, India dominated emerging market investing for a simple reason. There weren't many alternatives. As he puts it,
I think the big story on emerging markets in the past decade was that India was the only good story. Like Russia was obviously you could invest. China was said to be uninvestable as well. Brazil had political problems. So India was the only place.
this exclusivity gave India a large share of shrinking allocation pie. The future looks different, he says.
The next 5 years, you're going to see a rapidly growing emerging market pie, but the India piece might shrink, but the piece of the pie will still be bigger than what it is today, if that makes sense. You're going to get a smaller piece of a much bigger pie.
Now, this doesn't mean bad news for India. He clarifies this piece of the pie will be bigger than what it is today. You're going to get a smaller piece of a much bigger pie. Now, as institutional investor increases their overall allocations to emerging markets, India will face more competition for those dollars but will still benefit from increased total investment. Now, this represents a major shift in global capital flows. If Trump's policies succeed in weakening the dollar and lowering US interest rates, money will flow freely into all emerging markets, not just India. After years of raging bull on gold, he now sees better opportunities in industrial metals. His reasoning focuses on specific buyer behavior rather than abstract economies. See, gold's recent strength came from two groups. Central banks worried about geopolitical risk.
The first new marginal buyer were the central banks. When the Western world confiscated Russia's reserves, everybody said, okay, I'm not going to buy treasuries anymore, I'm going to buy gold.
And Chinese retail investors who lacked attractive domestic alternatives.
The other massive buyer of gold were the Chinese retail investors who had no confidence in their stock market, no confidence in their real estate market.
With Chinese equities now offering better returns and gold prices looking pretty expensive related to oil, relative to silver, relative to copper, he believes Chinese investors may redirect their money from gold to stocks. This would remove a major source of gold demand. Instead, Louis favors silver and copper, driven by a specific trend in Europe.
Europe is now moving from 12 years of fiscal consolidation to now big fiscal expansion.
While most analysts expect this spending to focus on defense, he predicts it will target energy independence.
When you lose the US protection, yes, you lose military protection, but you also lose the guarantee that the US will always deliver oil for you if you need it.
This energy insecurity will accelerate Europe's renewable energy transition, creating long-term demand for the industrial metals required for solar panels, wind turbines, and electrical infrastructure. Louis Gave's analysis reveals deeper patterns beneath headline market moves. As Trump's policy reshapes global capital flows, investors should reconsider basic assumptions about technology, leadership, currency values, and commodity demand. The concentrated focus on US tech, gold, and Indian equities that dominated recent years may give way to more diverse global opportunity. That's all for this episode. Thank you for tuning in. If you have any feedback for me, please let me know in the comments below. On a more granular note, how do you say granular? Yeah, start. On a more granular note, I need 1 minute.